very much kindly. I am monitoring the chat. We've got my incredible teammate, Diana, is going to also be monitoring this, along with Matt Emery, and Kellen Vaughn's going to be on there too. So they'll be monitoring this to try and make sure we make this very, very meaningful for you. So if you've got questions or something, go ahead and get it in there. Promise we're going to try and get to all of them. I'm going to go quick here, so put your mental roller skates on. And one request is a very important one. Please just think about this. I'm really easily distracted, okay? I'm an aware person like you guys are, and I like to multitask for a very short period of time here. Let's just not multitask, okay? My email's going, my phone's going. While I'm doing this intro, my phone's going crazy. I'm going to put all that aside right now because I'm just here for you. And I want you to be here for you too. Treat this like you're talking to a customer or a referral partner, because we're going to talk about some important things. I'm going to break them down so 100% you will understand them. They are complicated, but I think we have a way of making sure that you've got this and you own this so that you can be the teacher and you can do that. But if you're distracted, a lot of this stuff is going to be a little bit difficult to piece together because it is high level. So please, focus, not for me, for you, because I think this will be meaningful for you, especially in this market that we're transitioning into. We've been blessed. We've had this great environment, making good money. I want that to continue for you. I don't want you to lose out. I don't want you to be in a position where others are going to come in and take your business. I want you to, regardless of where rates are, be able to maintain that same lifestyle and that same level. So let's get started. I'm going to share my screen. As I said, monitoring the chat window, all that good stuff. So here we go. We're gonna begin, and I think what you see here is you see the slides for today's talk about housing interest rate outlook. We're going to throw the stock market in there and how to position yourself in this changing environment. I'm also going to take a quick look at where the market is now. And you know what? I'm going to start right there because I think that many of you are going to be concerned about what's going on here today. You see we're down 28 basis points. This is right on the MBS Highway side. I know so many of your MBS Highway subscribers. So we're going to take a look and just see where we have gone. Now, if I go and spread this out a little bit more, what we're looking at mortgage-backed security pricing. And when you take a look at mortgage-backed security pricing, as this goes up, that's really good. As it comes down, we lose a little pricing. So we're going to take a look first at mortgage bond pricing. And I want to show you a couple of things. You'll notice these little yellow markings. That is where we did an alert to lock. And we locked right at the very top, the best pricing ever, and then did not do any rate locks for 5 weeks as we were patient enough. And then at the very, very top, issued another rate lock. This is going to be a difficult level to get across in the future. So once mortgage-backed security prices came down, we were very patient, rode this all the way up, and then where did we lock? Exactly at the peak. But now you see the pain we've been in the past week. So if you take a look at where we were, why did we see this dramatic fall-off? This blue line here is called the 200-day moving average. And many of you that are part of Certified Mortgage Advisor, I know I've seen all your posts. You guys are all over it. You guys are interpreting this and understanding this and using this in your personal finances as well. Once you break this blue line, it's like a sea change. And as you can see, it's like falling through a trap door. Here we broke underneath it, but we didn't give it up. We were still attached to it, and then we came back with a very, very nice run up. But since we broke underneath, as you can see, it's gotten very ugly. We went from roughly 103 in pricing to 101.5. So almost 150 basis points that we've lost in price. It's about 3/8 higher in rate. And this is some of the heartburn you're experiencing now. So the question that you're going to have is, hey, when does this stop? So here's a couple of levels to look at. This 101.60, let's call it. And that right here is about 7 basis points below where we are. So while we're ugly today, we hit the floor on Wednesday and then we bounced higher. Will that same thing happen? I think we're definitely going to hit this floor again. We're going to test it. If this floor holds, we will likely see a nice bounce. If this floor breaks, we've got to be on guard because we're going to lose another, let's call it 40 basis points, 39 basis points to hit this level here. So about 40 basis points worse in price. So as ugly as this seems, if we get a little bit worse and we break under this floor, we got to protect ourselves. Now I want you to watch the 10-year Treasury because this is a good leading indicator. Now you know mortgages are based on mortgage bonds, which I'm showing you, but the 10-year Treasury is something we want to keep a watch on. And watch 137 on the 10-year. This will be your early signal. This is your canary in the coal mine. If we get to 137 and then we start to back off, we hit this ceiling and we back off, you'll get some relief. It'll be, I don't know if it's going to be long lasting, but at least in the interim, you will see some relief. So I think we'll hit 137. Once we do, once things start to back off, if we start to back off, you'll start to see some better pricing. Mortgage-backed securities will also improve. So this is your canary in the coal mine right now, 137. If we do, we'll probably bounce back down to 126 if we start to get some relief from there. All right, let's get to talking about what's happening right now in the marketplace. And the marketplace, if we start with stocks are unbelievably euphoric. But this is something that you have to watch for, because too much euphoria is a contrarian indicator. And I want to explain the reason for this. The reason why most contrarian investors are amongst the best and smartest investors of all time is because they understand that the markets really revolve around human dynamics and personality. We think we make rational decisions. I know we all do, me included, but the fact of the matter is, it's been tested and proven. We make the decisions that we make almost always emotionally, and then we justify them to ourselves rationally. So when we take a look at the markets, we have to understand that the market is an emotional mechanism. And when there is so much euphoria in the marketplace, it exhausts that upward move. So let's talk about some of the greatest investors of all time. Warren Buffett, who says you want to be fearful when others are greedy. And think about what's out there right now. Everybody's greedy all in the stock market, right? Sir John Templeton, one of my favorites, he said you want to be a buyer on the most pessimistic day and a seller on the most optimistic day. And he goes on to say that bull markets are born on pessimism. They grow on skepticism, mature on optimism, and die on euphoria. Now, we talk about dying on euphoria. There is an actual index. There's an indicator called the Panic Euphoria Index. It's done by Citigroup. And the index we are at now is virtually the highest level of euphoria ever. Now, every time we get to this level of 0.41, that indicates euphoria. We're right now near 2%. So 5 times a level of euphoria. And to give you some context, the dot-com bubble burst at 1.4. The 2007-2008 market, right at the level of euphoria, started to turn down. Here's where we are now. Does this mean there's a crash imminent? I can't say. We don't know if it's imminent, if it's going to happen, when it's going to happen. But what I am saying, that on a personal level, I will tell you this, my antenna is up. Now, there are outside forces that are causing this that we will explore in a minute as well. But this is a never, ever seen before circumstance with the level of euphoria. So why is that level of euphoria so important? Well, if you go back to 1929, there's a great example of this when Joe Kennedy, that's John F. Kennedy's father, he called the stock market crash in 1929. And, when he did, he really ruined the buzz for everybody because everybody was hopped up on cocaine, right? So the market was going crazy. Everybody's hopped up on cocaine. Remember, it used to be legal. They put it on Coca-Cola. It was the real thing back then. And when he came out and said the stock market's going to crash, everybody said, no way, no way, no way. And then shortly thereafter, when they said, how did you know? And he came up with this very interesting story that gave him the logic for it. He said, you know what? I was getting a shoe shine, and the shoe shine boy started talking stocks. And I thought to myself, if everybody's in the stock market, including the shoe shine boy, where's the new money going to come from? And he was right. And if you think about it, the real estate bubble, same thing. Dot-com bubble, same thing. Remember everybody day trading, things like that going on? So today, are you hearing some things that might remind you of those periods of time? As Mark Twain said, history doesn't always repeat itself, but it does tend to rhyme. And man, am I hearing a lot of rhyming. The other day I was at the chiropractor. True story, I was at the chiropractor. Before I went in, I hear the 2 doctors outside talking symbols with each other, stock symbols. Oh, did you get into this? Did you get into that? And I'm like, man, does this remind me of right before the dot-com bubble burst? And one of my mentors back then, a guy by the name of Jack Brumman, I put him in my book, and Jack told me back then, he said, Barry, he said, everybody's all euphoric about this, but one day, somebody's going to pull a plug on this thing, and it's not going to end well. Now, I can't tell you for sure if that's going to happen again, but I will tell you this. I'm hearing his words echo in the back of my mind, and I'm just reiterating those words to you because that was prophetic. It was sage advice to at least have your antenna up. There's things you can do to protect yourself. You want to talk to your financial advisor. I'm not saying go bury your money in the sand here, but at least be on guard because the stock market has been known to do the most damage to the most people at the absolute worst time, and boy, all those things kind of fit right about now. Now, back then, that shoe shine boy, it's been replaced today by what you hear every day in the news, Robinhood. less than experienced investors are out there. And there's a lot of young people, man. We got a lot of young people in our office, and it's so amazing to hear them talking stocks. So the symbols change from at least what I remember when the dot-com bubble burst. Back then it was the Yahoos of the world and whatnot. Today's that's the Neos and the Snowflakes and what you're hearing, and GameStop and all those things. The names have been changed, but the activity is the same. So for me personally, I am a bit concerned about the stock market. Now, we bring this up for a few reasons. Number one, listen, I want you to protect yourself, and I want you to just be aware of the extreme optimism in the market and how that typically is a leading indicator, another canary in the coal mine. But I also want you to be able to understand that this does affect interest rates, and that's what we're trying to forecast here. If the stock market were to take a big move lower, then that would actually help interest rates because money would come out of the stock market into the bond market as a safe haven. And I want to tell you something else that nobody else is talking about. I want to be kind of like the first one to tell you this. We accurately forecasted the recession. And everybody argued with me. Nobody thought it was going to happen. And it did happen before the lockdowns. It happened in February 2020. But I was talking about this in early 2019, saying in early 2020, you're going to have a recession because all the indicators were there. What I want to tell you is that I see a recession in 2022. Now, the timing is always hard, but I think that's coming. And why do I talk about this? Because you should start your planning. You have to be an advisor. And during recessionary periods, rates come down. Why do we see recession? Because I think, as we'll talk about the stimulus, it has a temporary effect. It's ephemeral. It will wear off. And when it does, what's going to be left is a lot of debt, a lot of slowdown, and what I think will be a hangover from the stimulus, resulting in, like it always has, at least close to a recession or a recession, which means there will be a lot of downward pressure on rates. So as an advisor, you aren't going to want people to be paying a lot of points today. You're not going to want people to be paying upfront MI, because I think at these levels of interest rates, there's going to be an opportunity for lower interest rates and a refinance opportunity that will be heading your way and your customers' way. Now, and by the way, I gave that same exact talk all of 2019, and how well did that work out? I said, don't pay points, don't take the lowest rate, take a higher rate if you can avoid fees, because you're going to have a refinance opportunity. Don't pay upfront MI, pay MI that's on a monthly basis. It seems more expensive monthly, but because it's about a 3.5-year break even on those, you're going to be better off. And sure enough, all of those came to be. I see a similar situation unfolding. Now, to underscore the stock expensive talk, my friend John Walden, dear friend, as well as Doug Cass, two of the smartest people on the planet, these guys did this work, and they showed that not only is this market expensive, it is the most expensive in history. We're talking about the stock market here. So it is in the 100th percentile in almost every metric: price to earnings, price to book, price to sell, everything you look at here. It is the most expensive stock market in history. Now, it was eclipsed by the 1929 or the dot-com bubble stock markets in some categories. But except for like these 4 categories and all the other ones, it is the absolute most expensive, either that or the second most expensive or potentially third most expensive in history by pretty much every metric out there. Does that mean a crash is coming? It doesn't, but as I said, my antenna is sure up. Now, we are due for a pullback, we just don't know when, right? Now, it's being hopped up on all this artificial juice, steroids, stimulus, $1.9 trillion package that is now on top of $900 billion, and followed by a package that they're talking about for infrastructure. Now, you can argue all these things could be good, but we don't have the money. And this stimulus that is coming, it might be too much. The analogy that I like to use is, hey, we just did $900 billion. We don't know the effects of this thing. It takes time to get through the system. It's kind of like if somebody has a bad cough. If you give them a spoon of codeine cough medicine, and in 10 minutes they're not cured, you fire a couple of more spoons down their throat, it does more harm to the individual than good. And I just hope that that's not the case here, although I'm concerned. I'm concerned that there is just too much stimulus in the system, and where is it finding its way into? If it's not finding its way into Robinhood, it's finding its way into DraftKings. And that's why you see this explosion in the marketplace. But remember, when this wears off, what's going to keep the market up? And that's why we may be in for a period of time that leads to a recession. There's also a lot of euphoria about the vaccine. Hey, thank goodness for this, right? Thank goodness we kind of can put this horrible pandemic in at least in a more manageable position. And then, of course, the Fed has been unbelievable unbelievably aggressive, and they lie. The Fed says, hey, we're going to buy $40 billion a month of mortgage-backed securities. Baloney. They're buying $100 billion a month. You can look it up. They've been doing that for months. The Fed is very aggressive. They're buying all kinds of treasuries. Why? They have to. They're monetizing our debt. And we've been talking about this with our subscribers for a long time. It's coming. It's called yield curve control, YCC. What does that mean? They did this in the 1940s where the Fed pegs a rate to the 10-year and a rate to the 30-year long bond, and they say this is where it's going to be, and we will buy an unlimited supply of treasuries in order to do that. And they're going to have to buy a lot because the debt that we have is so great that they're going to have to monetize this debt. Otherwise, interest rates are going to skyrocket, and they're not going to allow that to happen because that will just tank the economy. Now, are we turning Japanese? Remember that song by the Vapors? And that song, Turning Japanese? Well, I really think so, because in Japan, they've been trying to generate inflation for so long, and they have been unsuccessful in doing so. They've been trying to use QE. It was QE 1, 2, 3, and then it became QE infinity. We are following along in their exact footsteps. So I think QE is here to stay. I think yield curve is on the way, if it's not there already, and they're just not telling us. And this will help us in a way that's, thank goodness we're in the mortgage business, because what it means is that rates, while they're going through this upward cycle, they're not going to go crazy higher. And there's a very good chance that they cycle back down, which is something we want to understand. See, here's the thing. We've been pretty good at forecasting rates and understanding the way the market works in a way that other people don't understand because they don't understand debt. When we get ourselves into debt, and believe me, I'll talk about this, we've got a lot of debt. People think that getting into debt the way we are causes rates to go up. Oh, more debt, more rates have to go. And that is very logical in the short run. And we said this. All of our subscribers know this. We said at the end of 2020, we said we're going to go through an upward period, and then we thought that when the masks come off, rates will cycle back down. Everybody else thinks they're going to go higher. I'll explain why we disagree. You see, what we see here is a chart of the effect of debt on interest rates. Now, while everybody thinks that debt causes rates to rise, it's the exact opposite. So let's understand, and this is an important one for you to understand. This is what you should have been taught day one in the mortgage business. What causes rates to go up or down? And what it is it's inflation. The reason why inflation is such an important factor is because inflation erodes the buying power of a fixed payment like a mortgage. So look, you give me a mortgage. I pay you $2,000 a month. Every month you get a shopping list of stuff with that $2,000, and you go right down that list, you get everything, bingo, great. Next month, same thing, great. Next month, same thing, great. But over time, you realize that $2,000 can't get everything on that list anymore. Why? Because inflation causes prices to rise, and some stuff has to get left off the list. So what is happening? Your buying power, that same $2,000, that didn't change, but the buying power of it is eroding. It is becoming less valuable because of inflation. Now, you can deal with that because you know inflation is low and you know that's going to be a very gradual erosion of buying power. But what if inflation were to rise? Well, you can't do anything about the mortgage you gave me. However, on every future mortgage that you're going to be doing, what you say is, wait a minute, if my buying power is going to be eroding more rapidly, how do I protect myself? I got to start at a higher perch to offset the more rapid erosion. The only way I can do that is to charge a higher rate. So inflation causes rates to rise if it goes up, and like now, with low inflation, it's caused them to drop. But there are starting to see signs of inflation, especially on the good side. Not so much on the service side, on the good side. And I'll talk about why that's happening in a minute. Now, what causes inflation to come about? The strength of the economy, economic activity. An overheating economy means that there's more money out there, more people buying, drives the price of things up, services and goods up, causes inflation, causes rates to rise. A slow economy, no pricing pressure, everything's on sale, I'm not making any sales here. Inflation drops because prices go down. As inflation drops, interest rates can come down. So that's really important to understand this basic premise, that rates are driven by inflation, inflation is driven by economic activity. But economic activity is oftentimes driven by the amount of debt that the government has. So for example, when the government, this chart goes back to 1950, so when the government debt in pink drops, that's more money in the government's coffers to stimulate the economy. As they do, interest rates rise. As government debt goes up, interest rates decline. Debt goes up, rates decline. It's not just here. It's Germany. It's China. It's Japan. It's the UK. It's Italy. It's France. Debt goes up, rates go down. Debt goes up, rates go down. Everywhere in the world, every period in history, this phenomenon occurs. And it's something that most people don't understand. you an example of this. Imagine a family wants to buy a car. Now, back when we were kids, you remember what we had to do, right? You wanted to buy something, you'd save up for it, maybe you got a piggy bank, whatever, you save up for it, and then when you got your money, you break the piggy bank, you go buy it, feels good, right? Well, today we don't want to wait. We want instant gratification as adults, so what do? We buy it today, so we're taking a future purchase and we're moving it forward through the use of credit. Now, while we're able to buy it today, what we have to do is pay that off plus interest over time. So if a family wants to buy a car, they go out, they buy that car, and what that does is the purchase of that car creates some economic activity. It creates some stimulus. That stimulus that's created is good for the manufacturer, it's good for the dealership, it's good for the salesperson. They've got money, they go out and spend it, and it creates a little bit of economic activity. But it wears off after that, doesn't it? And what's left behind? What's left behind is the debt. That family now has that $800 or $900 a month payment, which gives them $800 or $900 a month every single month for the next 5 years, less stimulation for the economy. So the debt that we are having right now is having this huge impact initially, driving economic activity, driving rates higher, driving the stock market higher. But when it wears off, what's left is the debt. Thank God we're not printing money, everybody. I know we say we're not printing money, we're borrowing money. We're putting treasuries out there. The government doesn't have $1.9 trillion. So we've got to sell treasuries to you and take that money and then pay you interest for it. So the debt service is what drags down the economy. So listen, rates are going to remain low, but we're in this period of time that we're going to see this bump up like we've been calling for, and we're living it right now. How high do we go? It's possible if we break 1.37 on the 10-year, we'll get about 160. I don't think we go much higher than that because the Fed's going to panic. They'll just monetize more. Because if there's one thing the Fed really cares about, while they'll never say it and never admit it, it's the stock market. The Fed's all about the stock market.
Oh, this is our second
mortgage. We start to get above 150 on the 10-year. Stocks will start to have a tough time, start to move lower, and then the Fed's going to panic and they're going to take more action to keep yields pretty darn low. Now, we know that inflation is driving interest rates, but as I mentioned, it's pressured lower by debt. But what else pressures inflation lower? Technology, making things constantly cheaper and faster, easier to do. Now, our labor force is also down by 10 million people. Now, hopefully, a good portion of that will come back. And while people say, oh, well, when people come back to work, when the masks come up, that's going to cause rates to jump up. It is the exact opposite, everyone. They've got this wrong. Why? Because right now, the inflation that we're seeing is on the goods side. Why are goods more expensive? Because the inflation that is occurring there is due to supply chain disruptions. Hey, great example. What would you have paid for toilet paper when you couldn't find it in the store, right? Would you have paid a lot? Yes, because we need this. So when you don't have a supply chain, it wasn't that toilet paper stopped being, created. It was able to be created. We could not get the supply chain to work and to move. So that became more scarce and caused prices to go up because the demand was still there. Well, the demand's still there for these goods. The problem is that with 10 million less people in the supply chain, it's more difficult to get that to us, and it costs more to deliver that or produce that to us. So that's where we're seeing this inflation that's pushing rates a little bit higher. When these people come back to work, masks come off, hopefully over the summertime some period, you will start to see the alleviation of supply chain, lower prices, lower inflation, and some relief on interest rates. Now, in the interim, as I mentioned, the new administration, this new stimulus plan, the supply of treasuries to be sold, is going to cause rates to go up and bump up a little bit before resuming the downtrend. So be prepared for this. Be prepared to know that this is not rates are going up to 8% or 6% or 7%. It's not doing that. This is a temporary period of time. So think about this now as your role as an advisor. When you talk to your customer and you're doing today's mortgage loan, as an originator, I never did one mortgage at a time. I always did two at a time, meaning I'm doing your mortgage today in conjunction with the next mortgage we're going to do together. So if we think there's going to be a refinance opportunity in 2022, let's say I'm wrong, it's 2023, but around then, there'll be a move lower in rates, you'll have that refi opportunity. I'm not going to have you pay 6 points. I'm going to put you in a loan with the understanding that there's a high probability to refinance out of that loan within the next 2 years. So think along those terms. I'm not saying put them in a 1-year adjustable. If you put them in a fixed, don't go a lot of costs, don't go points, don't go upfront MI. Go with monthly MI. We know that debt slows growth and it lowers inflation. So how much debt do we have? Man, we've got $28 trillion in debt. $28 trillion in debt. Now, you hear trillion all the time. If you're coming into it, how much is $1 trillion? $1 trillion is, if you went out and you said, okay, I'm going to spend $1 million a day, every day, how long would it take to get to $1 trillion? Well, it would take you 2 2,700 years of spending $1 million every single day. You would have had to start in 700 BC at a clip of spending $1 million a day to reach $1 trillion. $1 trillion is a lot of money, and our debt in the United States is $28 trillion. And here is a very big culprit. She's back in the news. She's saying, oh, go big, go big, go big. She wants more and more spending. And like a teenager who's not responsible, who says, oh, we'll worry about it later. These are the words of your new Treasury Secretary. Look, she was a lousy Fed chair. Rates went up under her. She caused the wealth gap because she wanted the wealth effect, and she didn't realize when she gave people no alternative. Remember, TINA, there is no alternative, because she wanted to punish savers. So by punishing you for saving, she forced you to go into the stock market, drove stock prices higher. Her philosophy is, if you have more money in the stock market, your stock prices go up, you'll feel wealthier, and you'll spend more money. What she forgot is that not everybody's in the stock market, and she created the wealth gap. So it is so funny. Maybe her conscience is catching up with her. Every speech she gives is, oh, we've got to do more for this, we've got to do more for that, we've got to spend more. But by doing this irresponsibly and literally saying the words, she said the words, we can't worry about it now, we'll worry about it later, and we'll raise taxes. These are not the recipes for a healthy, long-term situation. Because of Janet Yellen, and listen, those of you that are MBS Highway subscribers, you know this. The day we found out that she was named as the next Treasury Secretary, not only did it mean her autograph would be on the new bills printed, but I said at that time, back in the fall, I said, watch the dollar tank, watch rates start to rise early in the year after she is in office, watch Bitcoin go crazy, gold go crazy, and silver go crazy. Why? Because by debasing the currency, by making the dollar less valuable, hard assets like gold, silver, and Bitcoin will start to become much more desirable. And that is what you're seeing, people moving away from the fiat currency because they do not have confidence in this woman, old Yeller. Now, you've got to be scratching your head sometimes, because what's going on in the marketplace is you're seeing rates rise, and yet the Fed keeps on pounding the table. They just talked about this Wednesday when they said, hey, we're going to keep rates low for a long time. Jerome Powell's telling us it's covered by every network. Your customer hears this, and then they hear you say, wait a minute, rates are up an eighth, a quarter, whatever it is. I don't believe you. The Fed says they're at zero. The Fed and mortgage rates are two separate things. You have to be able to explain this to your customer. And here you go. For the past 40 years, look at mortgage rates. Oh boy, remember 17% mortgage rates? Wow, isn't it funny? You tell somebody 3% today, they go, ah, it's high. It was 17% back here. Well, when you see mortgage rates trend lower, the red line is the Fed funds rate. You also see that trending lower. Now, we're 40 years. They both trend similarly. Okay. But your customer doesn't have 40 years to pick and choose a rate. Your customer may have 40 days, and within time frames here, they move differently. Fed can move up at the same time, mortgage rates go down. Fed can move down, same time mortgage rates can go up. Over and over and over and over again. But somebody might say, well, Barry, the Fed's at zero. Well, they were at zero. The Janet Yellen, Ben Bernanke years, right here, they were at zero for 7 years on the Fed funds rate. But mortgage rates did not stay the same. In fact, within 1 3-month period, they went up 1 full percent, from 4 1/8 to 5 1/8 in 3 months. You may recall that. Sounds fun. And then again, they went from 3.5 up 1.25% from there to 4 3/4. Not a lot of fun for us in the mortgage industry in a 4-month period to see that type of move. So to think that because the Fed's at zero, mortgage rates cannot change is a fool's game. You have to explain this to your customer. You have to get them off the fence, stop being complacent and cavalier if they're on the sidelines, and start understanding that they need to follow your advice as an advisor in the marketplace. Now, you know that we made a lot of good calls talking about all this stuff everywhere in saying that the 10-year treasury is going to go to 1. The reason why we were successful in that is because we took all the things I just explained to you and put them into practice. We've done that year after year after year. What I'm telling you is this. While we're going through this period of upward rates, I firmly believe that there will be a period that rates will relax a little bit, especially once the masks come off and supply chains are alleviated. Beyond that, I think 2022, 2023 perhaps, it's tough to get the timing on these down guys. But there will be a recession that will be coming because of the overhang, and that will cause rates to drop. You know, it's so funny, we got it right on the 1% on the 10-year treasury. Everybody else was out there talking about 4 or 5%. Only ones that got it right. And then after we did, nobody's satisfied. They want to bring you back, and they want to say on all the networks, they say, okay, so where do we go from here? And you can pull up this clip from Fox where I said I think the 10-year drops to 0.5%. Well, if you pull up the clip, you'll hear they say, I want to debate you on that. That'll never happen. Well, guess what? Shortly thereafter, it hit not just 0.5%, but exactly 0.5%, which was this once it broke 1%. And I'm telling you this because it's the same set of metrics that we used then to get this correctly, and for many, many years, that I'm sharing with you. I'm bringing you behind the curtain so you can see why we believe what we believe in interest rates. Now, let's shift to real estate, because this is a mess as far as the media goes. This is something that they've been so awful on their messaging, because your customer, especially right now, is hearing a lot of stuff about affordability. Prices are too high. Forbearance is going to be an issue. There's going to be a crash. And listen, all of our publications that we see, some of the ones that are either video telecasts that you see in our industry, or on the major networks, or in all the newsletters that you see in our industry, I hear a lot, and you probably do, a negativity about the housing market and how this is going to be a problem based on where we are. Team, the housing market is going to continue to be red hot. In fact, there's going to be an explosion to the upside. You ain't seen nothing yet. Let me explain why. This chart you're looking at here shows how many people were born every single year since 1928. Here's all your generations. Now, today's first-time home buyer is 33 years old, according to Zillow. That's the median age, which means that they were born right here in 1987 or 1988. But what I want you to look at is look into the future. Look into your own crystal ball, and what do you notice about what happened in 1989, 90, 91, 92? What happened to births? Births skyrocket. This is an explosive move higher in the amount of births, which is going to result in an explosive amount of demand from first-time homebuyers. Now, first-time homebuyers are really, really important, because a move-up buyer, what they do is they buy a home, which removes one from inventory, but they sell a home, which puts one back. So they don't change inventory. A first-time home buyer pulls one off inventory without replacing it, so they are depleting it. And now they are 33% of the market with no inventory out there on the lower end. And what's going to happen is that first-time home buyer will become 35, 37, 38% of the marketplace over the next few years. It is going to cause prices to move up rather dramatically. And we use the same thing to call the housing bubble when we did in 2006, because we said, hey, in 2006, look at what happened to 33-year-olds. 33-year-olds dropped dramatically. Why? A lot of reasons you might think of, but there's really one. Abortions were legalized, birth rates dropped, and then 33 years later, you did not have the buyers to go out and buy a home. Now, the next chart I'm going to show you will show you the supply-demand equation. It will show you the blue bars are households being formed. So that's those median-age 33-year-olds that are moving out of mommy and daddy, and what they're doing is they're getting their own place, they're turning the electric on in their own name. The gold bars are builders putting up homes. So the blue bars, demand. The gold bars, supply. Kind of close for this period of time, but what happened in 2006? Builders putting up homes like crazy, but nobody to buy them. Why? Because those people were the ones that were 33 median age and impacted by fewer births due to abortion being legalized. And if you look at this chart here and you see we have a big drop thanks to Roe v. Wade, kind of flat for a while, and then it's starting to climb. You can see here's why we have a housing bubble. A lot of supply, no demand. Here, for the last few years, a lot of demand, not enough supply. And look at how it's been exacerbated right here. Now, again, look at this pattern. Down because of abortion, flat, climb. Down because of abortion, flat, climb. It's a hand in glove. It has to be, because these people are coming. They were born 33 years ago. They're going to come. And what's going to happen here? You've got an explosion right here in births from 33 years ago. That's going to result here in this blue line exploding to the upside. And will builders keep up? They haven't been keeping up, because this is new construction. And construction has been way below to begin with. And then they got hit with COVID. You can't just take 6 months out of construction and make it up. Why do you think homes are jumping so much? Why do you think inventory is so low? Because the demand has been there, the purchase has been there, but the supply is not there. And exacerbating this is vacancies at an all-time low. The lowest amount of vacancies. Why is that important? Well, if my home's vacant, it's costing me $5,000 a month to carry it. You better believe I'll drop the price $10,000, $15,000. Just dump the damn thing, right? But if it's not vacant, I don't have that pressure on me to dump it and drop price, so I can preserve pricing integrity. All this is a recipe for the market we're in now continuing hot. And look, talk about supply and demand. It's so foolish for somebody to say, oh, this feels like a housing bubble. Well, this is a housing bubble. In 2007, you had 3.7 million homes for sale. Today we got the news number. I created the slides. It was 1.07, but it's 1.04. So inventory is dropping even further when we take a look at where we are right now. And I believe that when you look at this number here, not only does this show much more of a bleak situation on an inventory level here, which has to push prices higher, but you take a look at households being informed, and they're increasing. Back in 2007, there were 116 million households. Today, there's 128 million. So you've got 8 million more households. At the same time, 3 million fewer homes. This is why prices are rising. And people talk about forbearance. I hear it all the time. I heard it today on the news. People talk about it. People on the chat windows probably going to talk about forbearance too. So here's the thing with forbearance. If we understand it, let's remember a few things. People got into forbearance who didn't really need it, okay? Many of them. So that should not affect them. When they come out of forbearance, you don't have a bill to pay. You pay nothing. You resume your normal payments without anything that has to be made up, because what happens is that forbearance amount gets put into a security like a home equity line or like a second mortgage that rides alongside the first mortgage. There's no interest and no payments to be made. It's satisfied when you either refinance or when you sell your home or when you pay off your mortgage. That means that they will be staggered and they will not be this huge influx at the same time. You're not going to see a problem. And then even if somebody, unfortunately, now isn't in a position because they're not working to make their continuing mortgage payments, they've got equity in their homes. And that equity in their homes, average LTV on a home right now is 51. Average amount of equity in a home is $200,000. That's a lot. So people are going to protect that. And homes are selling really rapidly. Homes are selling overall in 21 days, but 71% of them are selling in less than 2 weeks. Those are the ones that are priced right. The ones that are crazy priced, yeah, those are the ones that sit and drive up the average overall. And when I talk about equity protect, look at how much equity people have in the homes. 87% of homes are below an 80 LTV. 95% are below 90. 37% free and clear. Heck, in 2009, 26% of the homes were above a 100 LTV. Now, the media is going to tell you every single chance they get, homes are not affordable. Affordability is a big problem. It's a big issue. It's unsustainable. That's because they look at the median home price going up at 16% and they look at hourly earnings going up at 5%. And they say, well, it is absolutely unsustainable for income to go up at 5% and home prices to go up at 16%. And you're going to hear Diana Olick, and everything you're going to get out of data is going to be telling you that this is an unsustainable situation. So therefore, when you look at something like this disparity, we have to clear it up because the media gets it wrong and they love to kind of scare folks into it. So first of all, the median home price up 16%. All that means the median home price today is $304,000. Last year was around $260,000. So the median home price just means that half the people purchased a home above that number, half the people below that number. That's all it means. And when we take a look at that and we say, all right, half above, half below, if there's not a lot of sales on the lower end and people are forced to make sales at the upper end, it's going to skew the median home price higher. Homes over $1 million, that's up 80%. The lower end of the home sales are down 28%. Not because people don't want to buy, it's because there isn't enough inventory to satisfy the demand. Now, actual appreciation is 10% per year. It's not 16, it's 10. Now somebody still goes, okay, Barry, well, 10% and hourly earnings are 5. Unsustainable, right? Not true. You see, hourly earnings are important, but that's not what you should look at. If you're smart about this, you look at weekly earnings. Weekly earnings mean that sometimes you're going to pay people more hours to do the work rather than hire somebody, pay a headhunter, pay a new set of employee benefits. It's cheaper to have somebody work more hours. So weekly earnings are 7.5%. So as you can see, this gap is narrowed, and somebody's still going to say, Barry, 10% appreciation, 7.5%, still unsustainable, right? Because they don't understand it. Because they need to do the math. And let's face it, math is hard, especially if you're in the media. Now, when we take a look at this team, here's what happens. I want to explain this to you so you can crystal clear deliver this message to your customers. Because you're going to hear this affordability argument. Your realtor does not know how to explain it. And now more than ever, you have to be a resource for them. If you want to especially be able to get their business right now to alleviate some of the lack of refinances. So, a year ago, somebody listened to Diana Olick, they didn't buy a home, and the payment would have been $1,000 a month for P&I only. You would have had to have had a roughly $5,000 a month income to qualify for that. So using round numbers here for conceptual purposes, this year the same home or a similar home, because appreciation was up 10%, means that if business rates stayed relatively stable, that payment would go up 5%. So the same home you could afford a year ago for $1,000 a month, you're paying
$1,000 more.
$100 a month. It is $100 a month more expensive. Therefore, you might say, well, it's less affordable by $100 a month, except your income would have to go up to some degree to offset that. So your income would have to go up by $100 a month, and then it's neutral. Then it is the same level of affordability. Your payment goes up 100, your income goes up 100. It is exactly as affordable as it was a year ago. So a 10% rise in price gets you that $100. But what percent rise in income gets you that $100? It's not 10%. It's 2%. Right now, incomes are going up at 7.5%. So believe it or not, you can go 10%, 15%, 20%, 30% appreciation. 30%.
I might have to order a deluxe
interest
pizza
rates remain
bowl.
stable. That home is more affordable, not less affordable. Fact, this is currently the 7th most affordable market on record. Let's do it one more way so we make sure we drive the point home. A year ago, home was $300,000. Prices went up 10%. So
I'm going to start making lists on Saturday lists. One of our lists is going to be getting
LTV, you got to borrow $27,000 more. Less affordable, right? Well, let's take a look. Interest rates have changed. Interest rates are about 0.75% cheaper, so that means your payment is actually about the same. $2 different per month. Now somebody's going to say, well, Barry, what about the MI? True. MI is a little more expensive, so we do this and we say, okay, you add that, my payment's $12 a month more. Not that big of a deal, but here's the big one people are missing. The income to qualify for this a year ago would have been $5,000 a month to qualify for this payment, right? Well, if income went up 7.5%, they're making $5,375 a month more. So they're making $375 a month more. Their payment is only $12 a month more. They've got an extra $363 a month. How is this home not more affordable? But the media doesn't get that because it's hard.
And you talk,
that
$300,000 home a year ago first quarter is not $330 this year.
7.5% appreciation. Now, what does that mean? Think about this: $100,000 home, 10% down. Down payment is $10,000. Grasp this, Steve. Grasp this. Maybe you want to write it down. $100,000 home, 10% down is a $10,000 down payment. That's your investment in the home. If that home goes up 7.5%, it went up $7,500. A $7,500 gain on a $10,000 investment is a 75% rate of return on your investment in real estate. It is indeed a good time to buy. Now, you have a problem that you're facing right now, and that is, should I bid more or should I bid full price? Do you know that right now 20% of transactions are cash transactions, which means that offers that are cash are probably 23, 24%, because not every cash offer gets accepted. So you got to combat a cash offer, or you got to combat competing offers. How do I do that? There's only one way to do it. You got to bid more. That means I got to come in either full asking price or over asking price. And nobody wants to do that. I don't want to do that. You don't want to do that. Your customer doesn't want to do that. It's tough for the realtor to get that customer to go ahead and push above that asking price. So what do? They come to you and you show them this bid over ask tool. What's the bid over ask tool do? Well, it will evaluate, because we have data on appreciation in every single individual zip code. And we have an ABM that's built in that will say, okay, this is a realistic in 90001. The asking price is 840. The ABM came in at 836, so they're pushing it a little bit above the ABM value on their asking price. But there's a cash offer in at 835. There's a full price offer in at 840. Somebody's coming in at 850. Somebody's coming in at 855. And in this particular example, if you wanted to buy the home, you got to come in $17,000 overall. Now, by the way, don't think I don't know that there's a lot of other offers that are crazy, $50,000, $60,000, $80,000. I'm giving you a real life example here. Now, in this particular example, the customer doesn't really want to pay about $21,000 more than the property is worth. They really don't want to do that. So how do we explain to them that's a good thing? Because what we want to do is we want to see how long will it take till the AVM value of this home, based upon what we know for forecasted appreciation, will it eclipse 857? When will the property that they have be worth more than what they paid for it? And we'll give you the answer. It's in April of 2021. So wait a minute, Barry, you're telling me that in just 2 months, I'm going to get my money back to the point where it's at least worth what I paid for it. That's absolutely right. Okay, maybe I can get my arms around that. Let me put that offer in at 857 and win this home and get this home. And by the way, over the next 5 years, let's just show you what this home is going to be worth. 255. And by the way, I always get a kick out of pulling this one up, because look at this home with the pool up right here with the basketball. You can dunk and dunk as you walk in the door. Now, people are using this having enormous success. This person, Jonathan Wells, by the way, he's got his CMA logo on his license plate, which I love. Use the bid over ask tool to get a buyer to go 10K over asking on a $255,000 permanent purchase. Buyer was lowballing everything prior to the report. Now we have an accepted offer. Love this group, love the tools we have. This is all over. Every day we get several of these. Thank you on the client being told it's a terrible time to buy. They have the cancel papers drawn up. They're listening to Adam Data. They're listening to Florida Atlantic University. They're reading all the stuff that's out there. Listening to Anna. Got them to agree to review an appreciation report and sleep on it. Woke up to this email. Nice work. Long talk about why. Showed her the email they sent me. Equity in the house is going up. She finally got it. Sent an email not to cancel. We will be buying this home. Such a great story. One more past 2 weeks. 8 pre-approvals, 4 purchases. Buy versus rent and the bid over ask tool. There's so many tools to use. Had 2 realtors reach out to me and say, another agent in my office works with you and I'd like to have coffee and talk about how we can work together. One of these had an in-house preferred lender. By the way, how great is that? That you're going to be the one because you have the gold. You have the goods. You have what everyone else wants. They're going to be coming to you. Team, this is a really important time. Don't be asleep at the wheel. You see all these SPACs. You see all these IPOs. You see these public companies. Heck, the mortgage industry is getting to a point where it's going to be hard for us to compete on rate. They are going to be able to win in a price war, these very large companies. So for the rest of us, we have to make sure that we are prepared with advice, with tools that can overcome disparities in rate. We're not going to be the lowest priced out there. Nobody is forever, right? So how do we win? How do we keep our level of earnings, regardless of the market, where we need them to be for your financial future? It's to convert more of the opportunities you have. You have ways to do that. Just implement them. Now, one of the great tools is an MB estimate. This is like the Zestimate from Zillow. Same stuff, except you don't have to have your customer or your realtor's customer go to zero because they're going to pixel them. Pixeling them means they've locked in their information and they're going to market to them. It's happened to you. You go to look for shoes, clothes, household goods, cars, and then you surf Instagram, Facebook, on the web, and you get targeted with that exact same item. Remember, that old saying, if you don't see a product, you are the product. So what will happen is when they go to Zillow's estimate, they don't see a product there, the product is them. So what they're getting is they're getting pixeled, and then they're going to be bombarded with ads from your competitors on the mortgage side, your realtor's competitor. So don't do that. Use the MB estimate. It's free in MBS Highway, and you can co-brand it with your realtor. And then if you really want to take the next step, you really want to lock up your realtor relationship, put it on your website or co-brand it and put it on your realtor's website. And when you do, now you drive traffic and capture leads, makes that realtor have a better listing presentation because all the traffic that they can show to advertise that listing. It is a home run, and you will build a moat around your business. You need to have something to offer that's different than your competitions. Lock up your realtor relationships. And then people get discouraged. So in our open house, where we have a separate report for the cost of waiting, because somebody says, I can't find a house, there's no inventory, maybe I'll come back in 6 months. Well, 6 months is going to be a lot more expensive. Let me show you how much. Let me show you why. You need to keep looking. You need to bid a little over asking price. Put it all together. It's a recipe for winning in this market, and that's what you have to do. Look, team, don't wring your hands, and don't worry about stuff you can't control. You have everything you need in your hands to win. You have every single thing at your disposal. There's only one thing you have to do is just decide if you're going to do it. You just have to decide that, okay, this has been a great ride, this has been nice, this has been fun, but as things start to change, you can be in denial, or you can get ahead of it, and you can protect you, your family, your future, your finances, and build your business regardless of rates. And you've got to be a web celebrity to do it. My friend Al Cassidy coined that phrase, I love web celebrity, it means a web celebrity. Because everybody knows you got to post videos. People say, well, what do I do? I don't know what to say. Well, we solved that for you. We have a program called Social Studio inside of MBS Highway, which we give you scripts, many, many scripts based upon what's happening. A lot of the stuff you heard me say, it's all done in script format for 30 or 40-second bites. All you got to do is go to our site. We turn your camera and your computer into a teleprompter, or you can do it on your phone. Read the script. We'll scroll it to the speed you want. We'll put in the font you want. And all you got to do is look at the camera. 30 or 40 seconds if you can read. You've got this thing. Now, if you don't like the tape, redo it until you get one you like, and then boom, one click, post it.